While Bitcoin has hit new all-time highs, we've subsequently had a correction, which is to be expected on the way up. And something major just happened on chain that most people probably missed. On October 6th, yesterday, 7,500 Bitcoin flowed into ETFs in a single day. That's nearly $1 billion in accumulation. And meanwhile, on-chain data is showing that people are withdrawing their Bitcoins from exchanges. So what does that mean for where we're actually headed? Today, I'm going to break down 3 on-chain metrics that show what institutions and long-term holders and short-term holders are doing, and one key resistance level that I'm watching closely. So let's dive in. First, the current chart is looking at what's happening with institutional flows, ETF inflows, and outflows. And this shows on-chain Bitcoin movements into and out of these ETF custodian wallets that we've identified on-chain. And so currently, we've been seeing an overall net positive inflow into these ETF wallets. And yesterday, when Bitcoin hit an all-time high, over 7,500, around 7,500 Bitcoin in inflows to ETF wallets. At current prices, that's nearly $1 billion in institutional accumulation. So for this metric, the green bars are inflows, right? And the institutions, that means institutions buying, custodying Bitcoin. And the red bars are outflows, essentially Bitcoin going out of the wallets and being distributed either into exchanges or other wallets. And so what's interesting about this is the pattern we're seeing right now. So we had massive accumulation earlier in 2024 when most of these ETFs first officially launched. And then it sort of cooled down during the summer consolidation when we went from around 72 to 58. And so we've seen a renewed interest in inflows at these all-time high levels, which is higher than the ones we saw during the first 124K all-time high. So we were seeing only around 600, 700, 1,000 Bitcoin inflows per day, and we're currently seeing around 5,000 to 2,000 to 7,500 Bitcoin per day in these institutional wallets, right? So institutions are buying the breakout, they're accumulating at these higher levels. This tells us that, demand is still strong, price discovery is still continuing, and these institutions do have convictions at these higher levels. But this can change quite quickly, as we've seen in the past, right? And so before we move on, I want to give a quick reality check on these ETF numbers. So this is an interesting chart that shows the supply distribution of where the total current circulating supply actually sits. And I'm using various metrics to calculate this data on chain. So let me just explain what some of these, what this distribution is currently showing. So the purple is the individuals / others. So this is active supply being held by these self-custody wallets, so individuals. It also shows miners, governments, private companies, and also unknown entities that we can't identify on chain. And so this represents basically economically active and decentralized ownership of Bitcoins, minus exchanges, ETFs, what strategies holding, as well as dormant or lost coins, right? And so then in blue, actually, wait, why is it not loading properly? It should show blue, but currently that's at 16%. So exchanges are currently holding around 16% of the total Bitcoin. And then strategy has around 3.2%. And then in gray, we're seeing dormant / lost coins. So these are either long-term holders or just coins that have been lost and haven't been moved for such a long time, right? So that's around 37%, right? So yes, even though ETFs accumulated around, 7,500 Bitcoin yesterday, that's pretty good for a single day. But when we put this into perspective, out of the total circulating supply, ETFs are only holding around 1.4 million Bitcoin total. That's only 7% of the circulating supply. And so when we look at the gray section, 37%, 7.39 million Bitcoin, that's either lost or dormant. And when you look at individuals, that's 36%, 7.25 million Bitcoin. That's more than ETFs, exchanges, and MicroStrategy combined, right? So the reality is, even though these institutions are accumulating aggressively, there's still a relatively small percentage of total supply compared to the decentralized holder base, so individuals or private held entities. And so this shows us, right, that Bitcoin's being held by individuals mostly. ETFs are growing, but they haven't had a dominating impact on the supply, overall supply yet. And a huge portion of that supply, around 17% or around 37%, is either locked up in long-term storage or is lost, right? So I want to look at these ETFs, these exchange inflows and outflows, right? So ETFs are holding around 7% of the supply and growing, but let's look at where the sort of the available liquid supply is at the moment, and that's in exchanges, right? So the amount of Bitcoin that's flowing in and out of these exchanges that's being traded on a daily basis. And so here's what we're seeing right now, at least on these exchange wallets. Right now we're seeing a net outflow, red bars. So Bitcoin's leaving these exchanges. On average, about 1,000 to 3,000 Bitcoin since September 15th have been leaving these exchanges and being withdrawn and deposited into self-custody wallets. So typically when Bitcoin starts to leave exchanges, it can signal either holders moving to cold storage, which can show long-term conviction for those holders. And number two, less supply is available for selling, right? And number three, reduced liquidity on exchanges. So here's what's important to understand though. Exchange flows are more nuanced than just saying, okay, inflows are bearish and outflows are bullish, right? So if we look at 2021, for example, we can see the first peak in and around April. We saw massive inflows, so people rushing to exchanges. But then the actual top in November to 69K, we were seeing net outflows, right? So the red bars. This was in part due to long-term holders still accumulating at those higher prices, right? So withdrawing their Bitcoin from exchanges. But in 2017, for example, it was different. We saw basically the entire run up to 20K, we saw massive sustained inflows as we approached the top. And then even after the cycle top was in, we still saw massive inflows into exchanges, right? So in 2017, it was primarily retail driven. Retail rushed to exchanges to deposit and do what they were going to do, either sell, trade, or buy more. So in 2021, in the second peak in 2021, you had some long-term holders still accumulating even at all-time highs, which created these outflows despite being near the top. So right now, even though we're seeing a majority net outflows, it doesn't necessarily mean that's a good thing. It does, in my opinion, mean it's a good thing right now, at least because of the situation that we're in with ETFs accumulating and long-term holders still accumulating at these, or short-term holders still accumulating at these prices. And so the next metric I want to talk about is the long-term holder profit to volatility ratio with statistical bands, okay? So alongside MVRV, which I talked in the last video, this is another metric that I'm personally following pretty close right now. And so background on this metric, this measures how extreme these long-term holders profits we talked about are relative to their typical market cap volatility. So it's not a z-score like the MVRV z-score, it's a profit to volatility ratio, right? So right now, this ratio is sitting at about 3.051. That means long-term holders' unrealized profit relative to volatility equal 3.05 typical market volatility, so 3.05x. And when we turn on these statistical bands, right, so we can see what historically when long-term holder profit to volatility reaches around a high level, statistically meaningfully high level, we can essentially map these statistical bands onto the price. And when we see it go above plus 2.5, and similarly when we see it go below 0.75 standard deviation, that can either correspond to market cycle tops or market cycle bottoms. right? So with these bands, we can ask this question: what price would Bitcoin have to go to in order to reach these, statistically overheated levels? And so right now the plus 2.5 band is projecting at around, let me check real quick. Let me just turn off these ones. So the plus 2.5 is saying the price would have to reach to 129K to reach that 129.2K to reach the plus 2.5. And so this band can move up over time as the market evolves. So by the time we reach 129K, if we do, the band might be at either 130 or 131K. So you can see when we first hit 106K, the band was at 122K. By the time we were at 124K, the band was at 127K. So this can move up. And so let's just take a look at prior market cycle tops when we historically have reached this plus 2.5 band. So in 2017, we broke above it for the first time at around a price of 11K, okay? And so then after we went above it sustainably, we saw the all-time high at 19.5K, around 20K. In the first peak in 2021 at 64K, this tagged it the plus 2.5 band, as well as during the first run up to 62K, I believe it was. And then in the secondary peak, we saw this once again, price go above the plus 2.5. You can also see it in prior market cycle tops, such as the 2013 and 2011. So in every case, the price went above the band. And in my opinion, simply hitting this band does not necessarily have to mark the top, but hitting it and going above it has marked areas of extreme risk in the market. So right now at around 3 to 3.15 for the long-term holder profit-to-volatility ratio, we're approaching but haven't hit that plus 3.5 level like we have in the secondary peak in 2021, in 2017, in 2013, and 2011. Currently, the max we've gone to is around 3.2. And so this is another reason why looking at newer metrics and coming up with these newer calculations can help, because if you look at all the other metrics that people have historically looked to for times that the market's gone overheated, such as the MVRV Z-score and other metrics such as the Puel multiple and Nupal, for example, they haven't really reached these higher levels that we've seen in the PVR, right? So the MVRV Z-score looks relatively muted, and it's only at around 2.4 comparatively. When it hits around above 6 to 7, that typically marks cycle tops. And you can also see during the secondary peak in 2021, this didn't really get overheated. We saw sort of this divergence in the metric where it hit a lower high. And so in my opinion, I do think this metric is better than 99% of the metrics out there right now, in part because it ignores short-term holders. It only looks at long-term holders, but also focuses only on these conviction holders and normalizes by its relevant volatility. So here's what I'm watching in my shorter term framework. So last video I talked about MVRV statistical bands, similar to how I'm talking about the long-term holder PVR bands. In my last video, I talked about how if the price reached around 140K to 130K or 130 to 140K, that's an area of interest of the +1 MVRV standard deviation band. So if we hit that 130 to 135K, 140K range, and the long-term holder profit to volatility ratio breaks above 3.5, sustainably going above 2.5 as well on the standard deviation band, once we hit that 130 to 140K, that's my first target. All right, so we'd have to get to 130 before going to 140 and assessing risk at that point, because like I said, these metrics are dynamic and they're going to change every day, and they'll update every day. So if we're at 130 and some of these metrics are starting to get overheated, then I'll likely start to de-risk. But honestly, a lot of these metrics are not getting overheated. Like if we look at MVRV and Puel multiple and Nupal, they're not getting to those extreme levels yet. So the long-term holder PVR is one of those that I'm especially following because it's accounting for Bitcoin's growing market cap and diminished volatility. So a lot of these metrics, in my opinion, will break because they're not inherently calculating for that. So to sum up, historically, when patient holders that have bought years ago are experiencing 3 to 4x volatility and unrealized profits, such as this chart is showing, that's when they start to distribute heavily, and that's when we start to see these major market cycle tops play out. So in my last video, I talked about the long-term holder realized profit to loss ratio, and this metric confirms this sort of picture that I've been painting in this video. So this measures actual profits versus losses being locked on chain when these long-term holders are moving their coins. And you can also look at it through the overall market profit and loss. So we have it for short-term holders, we have for long-term holders, and we also have it for the overall market. So combining everything together to see what the overall market is experiencing. So as this ratio, the long-term holder realized profit to loss ratio, goes up, that means more profits are being locked in than losses. And when it goes down below 1, that means more losses are being locked in than profits. And so historically, when this is spiked up to near extreme levels, we've seen market cycle tops. Right now, we actually just hit around that historical level, right? So when we were hitting these all-time highs at around 119, 124, that's when we saw this start to get elevated. We actually saw it go up to these elevated levels at around 124K. Subsequently, we've had this sort of pullback. We haven't gotten into that region where long-term holders are starting to realize losses. So just because we've had this pullback, I still think the market is intact. I don't think that if we start to go down from here, I don't think we'll see a sustainable drawdown unless we go below the short-term holder cost basis, which is something that I've talked about in the last video. And so right now, long-term holders are still distributing, yes, but not panic dumping, not aggressive top selling, right? This is a measured, healthy, late-stage cycle distribution like we've seen in prior cycles. Old hands rotating to new hands are willing to buy at these higher prices. So to sort of connect the dots here, long-term holders are still distributing. ETFs are absorbing some supply. Exchanges are seeing net outflows in Bitcoins and for Bitcoin, and the rotation is sort of happening, right? Patient holders taking profits after holding for years. Institutions stepping in and accumulating. Meanwhile, these exchanges are bleeding Bitcoin. Total available supply is shrinking. This is sort of what we've seen in all prior late stage cycles. And so my thesis is, obviously we're in a late stage cycle territory. Distribution is happening, but we haven't yet hit those extreme statistical levels on a lot of the metrics. And from here on, my key short-term levels are still 130 to 135, where long-term holder PVR and MVRV will hit those +1 and +2.5 bands. And if we go beyond these levels, that's when I'll start to look at the MVRV bands if it goes to 140. So all these charts are 100% for free on chartinspect.com. You can explore them yourself, toggle the bands, see the exact levels, apply different smoothing averages so you can see the raw values of these exchange inflows and outflows, and you can also apply smoothing. You can see it from a separate level, so overall inflows and outflows rather than just the net view. And you can also apply different variations of methods onto the data. So if you want to look at it from a USD perspective, you can see that. If you want to look at it from Bitcoin denomination, you can see that as well. So if this analysis helped you understand where we're at in the cycle, subscribe for more on-chain data and drop a comment on what you're watching closely. Thanks for watching, and I'll see you guys in the next one. Bye.